Welcome back to Iron Financial. I'm your lead analyst, and as always, I'm sitting down with our resident market skeptic. Now, if you're new here, our mission is simple. We're here to help you forge a stronger, more resilient portfolio. We cut through the relentless market weakness, and we separate actual, undeniable financial muscle from the fluff and corporate PR hype. Today, we're throwing DoorDash's Q2 2026 earnings report straight into the crucible. So make sure you hit that subscribe button and like this explainer so we can keep building bulletproof portfolios together. And look, we've got a massive earnings release to tear down today. DoorDash is printing numbers right now that honestly look incredibly strong on the surface. But as we know all too well on this channel, the devil is always in the details. Remember, we're evaluating this company in a brutal macroeconomic environment. Consumers are feeling the very real pinch of sustained inflation. Discretionary spending is tightening up everywhere you look, and capital is no longer cheap. So, when a giant consumer discretionary platform like DoorDash drops an earnings report, we're going to stress test that foundation to the absolute limit. We need to see if it actually holds up under real-world pressure.
Exactly. So here's the structural blueprint for today's teardown. We're covering the hook, the M&A distortion, GAAP versus EBITDA, cash flow heavy lifting, guidance and risks, and finally, we'll wrap up with the verdict. Let's get to work.
Starting with Section 1, the hook, top-line surge versus bottom-line plunge.
All right, let's heat up the crucible right out of the gate by looking at the massive contrasting metrics defining this quarter. When you're looking for a structural compounder in the market, you want everything moving up and to the right in tandem, right? But that is exactly what we are not seeing here today. First off, you literally cannot deny the sheer brute force of this top-line revenue print. DoorDash generated $4.45 billion in revenue for Q2 2026. That is a blistering 36% year-over-year surge. I mean, in any market environment, pushing almost $4.5 billion through the top of your income statement in a single quarter is a massive feat of financial engineering and operational scale. But in an economy where household budgets are heavily constrained, it's genuinely impressive. It shows that their core utility remains incredibly sticky with consumers, even as checkout totals get higher and higher.
Yeah, it's a huge number. I'll gladly give you that. Scaling an operation to that level of quarterly revenue is an undeniable achievement. But, and this is a massive but, top-line growth is only impressive if it actually flows down into the foundation of the business. We are seeing this exact same problem across the entire tech sector right now. You've got these companies successfully driving massive volume, but they are absolutely incinerating capital just to make it happen.
Because right underneath that massive revenue surge, we start to see some very severe cracks in the armor. GAAP net income absolutely plummeted this quarter. It dropped a staggering 30% year-over-year, sinking all the way down to just $200 million. I want everyone to just think about the sheer math here for a second. Last year, in Q2 of 2025, they posted $285 million in actual net income. So fast forward to today, they just generated roughly $1 billion more in top-line revenue this quarter, yet somehow they walked away with $85 million less in actual bottom-line GAAP profit. How does that happen?
And that right there is the exact friction point we have to aggressively investigate today. You simply cannot forge a durable long-term portfolio by ignoring a 30% drop in net income while revenue grows by 36%. That is margin degradation happening right in front of us in real time. We need to find out exactly where the heat is escaping the engine.
Hit the nail on the head. And that brings up the absolute first major question we have to ask about this foundation. Is this growth structural, or is it just an M&A illusion? Are we looking at a company that's organically compounding its market share, or are they just going out and buying revenue through massive acquisitions to paper over a slowing momentum in their core operations?
Which brings us to Section 2, the Deliveroo M&A distortion.
So, to answer your question, we need to transition into the second phase of our teardown and really start hammering out the impurities. We're going to specifically strip away the impact of the massive Deliveroo acquisition to see what the unbought, organic machinery of DoorDash actually looks like underneath. Let's drill right into this side-by-side contrast, because this is where the corporate PR gets violently separated from the underlying reality of the business. On the left side of the data, you have the headline numbers. These are the numbers designed to dazzle Wall Street analysts and trigger those algorithmic buy programs. Total orders up 27%, marketplace gross order value, or GOV, up 36% to a staggering $33.1 billion, and revenue up 36%. But we have to strip Deliveroo out of the mix. Look at the true organic growth on the right side. Total orders only grew 17%, not 27%.
Marketplace GOV grew 23%, not 36%, and revenue grew 24%, not 36%. Yes, obviously it is still growth, but the reported metrics are severely masking a significantly slower underlying reality. That M&A is absolutely doing the heavy lifting to prop up those headline growth percentages.
Right, the M&A is moving the needle, but let's look at the broader context of what's driving this. Yes, Deliveroo is undeniably doing heavy lifting, but let's be fair, a 24% organic revenue growth rate is still a remarkably solid foundation for a company operating at this immense scale. However, we have to look closely at the margin trade-off happening right now within their DashPass ecosystem. This is critical. They are seeing massive adoption in U.S. grocery and retail categories. In fact, those categories now make up roughly 75% of their total orders. They literally added more paid U.S. DashPass members in the last 12 months than they did in the previous 24 months combined. That is insane growth.
Sure, but what is the actual cost of that growth?
And that is the key structural trade-off. While expanding heavily into grocery and retail absolutely lowers their gross margin percentage on a strict per-order basis, it serves a much larger purpose. It drives significantly higher order frequency and heavily bolsters their customer lifetime value, or LTV. It's a highly calculated sacrifice of short-term margin percentages for long-term ecosystem lock-in. Basically, they're betting that if you start buying your weekly groceries through them, you are never going to delete the app.
Moving on to Section 3, the GAAP versus Adjusted EBITDA disconnect.
Okay, I hear your argument for ecosystem lock-in. I really do. But at the end of the day, the core business still has to actually make real money. So let's move to the next phase of our stress test. We need to explore the massive, cavernous gap between bottom-line reality and adjusted optics, because this is where the financial engineering really starts to warp the steel. I demand absolute clarity on this from management. How does a company print nearly $1 billion, $914 million to be exact, in adjusted EBITDA, which is up 40% year over year, while their actual real-world GAAP net income falls by 30% to a measly $200 million? Adjusted EBITDA is now sitting at 2.8% of GOV. But honestly, it feels like a massive smokescreen. Think about it. You cannot pay cash dividends, you cannot service real corporate debt, and you cannot fund true hard asset acquisitions with adjusted optics. You need cold, hard GAAP reality to run a business long term.
To answer that, we have to point directly to the financial receipts. If you look at the GAAP cost of revenue, strictly exclusive of depreciation and amortization, it jumped 30% to $2.1 billion. Now, structurally speaking, that makes logical sense, right? It tracks very closely with the 27% increase in total reported orders we just discussed. If you deliver more food, your core delivery costs are naturally going to go up. But the real structural stress, the actual heat that is warping the earnings profile here, is happening right below that line. It is entirely contained within the operating expenses.
It's an absolute OpEx explosion, and it is highly alarming. Let's break down this intense expense inflation piece by piece, because the viewers need to see where the cash is going. Sales and marketing surged 35% to $821 million. That's driven heavily by relentless advertising spend and personnel compensation. Research and development, that skyrocketed a massive 52% to $535 million, primarily due to headcount and third-party software expenses. And general and administrative spiked 39% to $538 million. And let's be extremely clear on what is driving that G&A jump. It's being propelled by legal, tax, and regulatory expenses. Get this, they are actively building up nearly $100 million, $98 million to be precise, in fresh legal reserves. That is a massive structural risk operating in the gig economy. As state and local governments continually try to reclassify drivers as employees rather than independent contractors, companies like DoorDash are essentially sitting on a regulatory ticking time bomb, and we are seeing it bleed directly into their operational costs. The underlying math here simply cannot be ignored. If you combine those three core operating expense lines we just went over, they grew by a massive 41% year over year. And this brings us to a fundamental structural crack in their current earnings profile. You simply cannot build a durable, long-term compounder if your core operating expenses are growing at 41%, while your true organic top-line expansion is only growing at 24%. It's a mathematical certainty that your margins will compress over time if that dynamic isn't forcefully corrected. They are burning the engine incredibly hot just to maintain their current cruising speed.
All right, let's look at Section 4, cash flow and capital heavy lifting.
Let's pivot away from the noise and the non-cash expenses of the income statement for a minute. Let's examine where the real structural payload lies: cash generation.
Earnings can be massaged by accountants all day long, but cash flow is the raw, forged iron of a business. And here, we really have to highlight their undeniable financial muscle. Despite the concerning net income drop we just dissected, cash generation moved aggressively in the exact opposite direction. Net cash provided by operating activities surged an incredible 87% year-over-year, jumping from $504 million in Q2 of last year all the way up to $944 million this quarter. This proves beyond a shadow of a doubt that the core platform is generating serious, tangible liquidity.
Okay, I will acknowledge the cash generation is robust. Free cash flow more than doubled year over year, hitting a very impressive $742 million, which is up 109%. But look closely at how they are actually allocating that hard-earned capital. Year to date, they have spent over $1 billion, $1.049 billion to be exact, repurchasing 6.8 million of their own shares. So the question is this a genuine sign of corporate strength, or are they just desperately bailing water to offset massive stock-based compensation dilution? They recorded $349 million in stock-based compensation this quarter alone. Think about it. If you are relentlessly printing new shares to pay your engineers and executives, and then turning around and using your free cash flow to buy those exact same shares back on the open market, you aren't really returning capital to your shareholders. You are just papering over your exorbitant compensation expenses so your share count doesn't absolutely explode.
Moving into Section 5, Guidance and Risks.
Look, that is a completely fair critique of their capital allocation strategy. Now let's move to the forward outlook to test if this foundation can hold up under future market pressure. Looking through the windshield is always more critical for investors than staring in the rearview mirror. Let's break down the newly issued Q3 guidance. DoorDash expects marketplace GOV to land somewhere between $33.0 billion and $34.0 billion. Now, if you compare that directly to the $33.1 billion they literally just printed in Q2, they are essentially guiding for flat sequential growth as we head into the third quarter. They also expect adjusted EBITDA to come in between $950 million and $1.10 billion, which does represent a slight sequential increase. So, in the immediate near term, the foundation looks relatively stable. Stable for Q3, maybe, but I am immediately flagging the expected Q4 margin contraction that they specifically outlined in this release. They are actively warning us right now, months in advance, that Q4 will see a decline in adjusted EBITDA as a percentage of GOV. The baseline drivers they cite are seasonal Dasher costs and annual insurance expense hikes. But what's much more concerning is the heavy capital expenditure required to keep this platform competitive long-term. First, they are dumping massive amounts of cash into rolling out a single global tech platform, which won't even be fully realized until the first half of 2027. Second, they are heavily funding some highly speculative autonomy initiatives. Right now, they are targeting .robots to handle a high single-digit percentage of all orders in their top market by year-end. Plus, they are aggressively chasing FAA Part 135 certification for DoorDash Air Logistics, pouring tons of money into drone delivery networks. You have to ask yourself, are these legitimate ROI drivers that will structurally improve future margins, or are these just wildly expensive science experiments draining current cash flows just to generate cool press releases?
And I need to further warn our viewers about the massive upcoming structural headwinds outlined for the full year of 2026. They are officially guiding for $1.2 billion to $1.3 billion in stock-based compensation. As we discussed earlier, that is a massive, relentless dilution engine running quietly in the background, constantly demanding free cash flow to offset it. Furthermore, they specifically noted that the year-end timing for massive merchant payments is expected to act as a $700 million to $800 million deadweight drag on reported free cash flow in the fourth quarter. These are heavy, undeniable capital headwinds that could act as a severe drag on overall shareholder equity moving forward.
Finally, Section 6, the verdict.
The numbers are on the table, the metrics have been thoroughly tested, and the stress test is finally complete. It is time to cool the iron and deliver the final, definitive iron financial verdict on DoorDash's Q2 performance. For anyone currently managing a position in this name, or if you're looking to build one, here is your strict structural blueprint. Grab a pen. First, you must relentlessly monitor organic GOV growth versus bot revenue. Deliveroo is juicing the headline numbers today, but that 24% organic revenue growth is what actually dictates long-term survival in this competitive space. Second, rigorously track the OpEx growth versus top-line expansion. If operating expenses continue to grow at 41% while true revenue only grows at 24%, this foundation will inevitably crack under the sheer weight of its own bloat.
And third, watch cash generation durability against stock-based compensation. The raw operating cash flow is undeniably strong, but you have to ensure it isn't being completely consumed by share buybacks designed solely to hide employee dilution from retail investors.
Which leaves us with the ultimate structural question for you, the viewer. After stripping away all the adjusted metrics, stripping away the M&A noise, and looking purely at the cold, hard reality of the unit economics, what do you see? Is Dash stock an ironclad compounder, successfully leveraging its massive global scale into huge future free cash flow? Or is it an expensive, high OPEX trap that is simply papering over fundamental structural cracks with endless share buybacks? Let us know your thesis in the comments below. And hey, if this explainer helped you reinforce your own portfolio today, make sure to hit that subscribe button for more deep dives. Stay disciplined out there.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.